Well, let's get Alistair Schultz's take on what he's expecting from the markets open day. He's joining us now live from Sydney from acysecurities. Morning, Alistair. Well,
good morning. How are you guys?
Good, Alistair. As always, expecting a market rally again today. It just seems to be never-ending, at least around the world. But volatility has held steady even on the back of this strong move in the US. Was this to be expected? Is this now the floor for the VIX around the 28 mark?
Look, I don't think it's going to be the floor for it. I mean, if you go back historically and look at where prices have actually sat and where the volatility index has been sitting, it's got plenty of room to go further down, and it certainly has more room to go up. I mean, we've seen the S&P 500 climb 40% this year alone. Now, the biggest interest to me is really on the divergence that we're seeing between the VIX index and, of course, the S&P 500. Usually you would see them sort of remain elevated for a period of time, and that would provide us with an opportunity there to sort of sit and have a look at what's really going on. And that's really been driven by a lot of the stimulus that we're seeing. And so there's a lot of other things on the table here that are really affecting the drive up beyond just the volatility levels.
But in terms of what we're seeing on that drive up, I think you stated earlier you thought it was a bit irrational. Certainly, we've heard a lot of commentary about it being irrational, but just continuing higher anyway.
Absolutely. I think when it comes to the irrational side of things here, there are a number of different reasons for it. We've got a whole heap of new investors that have joined the market that are really operating from more of a speculator side of things. We've also got probably a lot of people who would usually be what you would consider to be short sellers in the market, just not competing, only because they're seeing such high levels of volatility. And you'd also have to look at some of the volatility traders out there that would also be struggling right now because they're looking at one side and seeing obviously the technical divergence, if you will, of the difference between equity rallies versus the actual volatility ratio. So that's certainly adding to their problems.
Forward, I guess, the question is, what would sort of put a circuit breaker into markets in your view? What are the downside risks to markets?
Absolutely. I think the coming months that we've really got coming up, we've got an election, we have still an ongoing pandemic, we have earnings season going forward pretty much in the next couple of weeks. And after the last earnings season, where we only saw maybe 80% of companies actually not providing any advice, it'll be interesting to see what happens this time round. And then you've also got the sort of uncertainty that comes with the ability for commodity markets as well. We have a number of countries that would usually be a high commodity supplier unable to do so at this point in time.
So speaking from the commodity front then, we've got oil still holding over that $40 barrel mark for WTI. Is there any real sentiment, any shift other than the demand-supply conundrum as to where that's going to go? It seems that every other asset class can just get spurned upwards from liquidity standpoint. Will it be the same for oil?
No, I don't think it will be. I mean, whilst the stimulus that we're seeing and the sort of cash supply that's going forward for equity markets is certainly helping businesses, it doesn't seem all that likely that commodities are going to receive the same benefit. Naturally, whenever there is stimulus, you do tend to get a bit of an overflow into emerging markets, and predominantly many of the emerging markets around the globe are heavily reliant on commodity prices. And when it comes to oil specifically, the most aggressive forecast sort of suggests that we would see a peak period of oil demand in 2020. But that doesn't necessarily mean it's going to be the case. There are others that are anticipating that demand be sort of the peak demand being a lot later. But now that we've sort of had a bit of a wobbly start to the oil price season, and that's really been held on by the fact that we're now sort of getting a resurgence of virus. It's hard to say that whether it's the second wave or it's still the original wave that's really going forward. But either way, the shake-up of having such a large number of cases going basically on a daily basis is certainly putting people's concerns in the idea of air travel or even domestic travel via car in question. They're trying to avoid those public places. So the majority of your sort of, where the oil is going to is unlikely to get used. And so therefore your demand is going to come down just as much as the consumers want to actually travel is as well.
Yeah, and we're also watching emerging markets, I guess, and OPEC countries in particular, or OPEC members in particular, to be hit hard by lower prices.
Oh, absolutely. I mean, realistically, if you look at Russia and then you were to look at, say, Saudi Arabia, they're probably the best position to sort of weather the storm, I suppose. Really only because they've got such large foreign currency reserves able to sort of help, support them throughout the time. But if you start to look at other countries such as, Turkey or any of the other ones where they don't have those foreign currency reserves, they're going to run into problems and they don't have the same sort of oil production for export. Naturally, countries like Venezuela and any of the other sort of minor OPEC nations like Nigeria or any of the following really do cause get a real effect from the valuation of where oil is. The lower that oil price is, the less they're able to actually attract sort of foreign investment as well, because they just don't have the funds coming in from one side to be able to afford to get the others.
We speak a lot about the concerns in the global markets at the moment, Alistair, but we've got US, they've had 5 consecutive daily gains, NASDAQ's at records, China's now back up near those 2015 highs. Just doesn't seem like anything's really going to get in the way of equities at the moment.
No, it doesn't. And I suppose to a certain degree to myself, I mean, if you were to go back 5 years ago and look at using the China stocks as an example, and we did see equities rise up very quickly and we saw them bubble over almost at the same rate. So I'm curious as to whether now, if we're seeing something kind of the same thing, if you go back to the GFC, what caused the bubble in credit markets or defaults or anywhere else, and previously in the dot-com bubble, it was one of those things where every time you saw a bubbling asset class sort of emerge, it was too late before people started to really catch on to the idea of it. And I am certainly curious now if that's what we're seeing. It feels that the amount of sort of emotion that's in the market and the amount of people that are really just investing for the sake of the greedy side of things and not taking into account what actually equity markets and the companies behind them are able to actually put out. I mean, a perfect example of this is if you look at Tesla. Tesla has basically had no sort of deliverables really done. They've certainly cut more than in half. And we haven't been able to actually see whether or not that's resulted in them actually making more money or not. Yet their valuation has times by 6 in the last 12 months, which certainly brings to question, the viability of, is this just a case of what's going on with this whole ESG movement and the push away from oil, or is there more to it than that? And are we really looking at sort of people feeling on the flight of what Elon Musk can do and or the rest of the company itself? Who knows?
Well, time will tell, Alistair. It's been a pleasure as always having you join us, taking us through what's going on around the world. Speak to you soon.
No worries. Thank you for having me.